Today, I finally got in contact with a mortgage lender. It ended up being one of the least enjoyable phone calls I've had in years, and I've had some pretty bad phone calls in my life. I learned that unless you want to live in the hood, or on a farm, or in a shack, then the housing market is fundamentally changing from the way it was a year ago. Jerome Powell and his clan at the Federal Reserve are way behind the power curve. Interest rates have been too low for too long, and this is one of the major factors that led to this year's inflation rate hitting a 40-year high. Now, Jpow needs to raise rates quickly to bring inflation to heel before it completely guts the middle class. Doing so is going to cause casualties, and one of those casualties is the housing market. Let's crunch a few numbers. According to the St. Louis Fed, the median home price in Q4 of 2021 was $408,000. The median mortgage interest rate at the time was 3.1%. Excluding any taxes or fees, just interest and principal, the median borrower was paying about $1,700 a month on his mortgage. That's not bad at all. That's lower than the rent in most cities. But the rate hikes the Fed has already implemented by April 2022 is pushing mortgage interest rates to 5.1%. If we do that same math, this is the exact same house just purchased 5 months later, your monthly payment is now about $2,170 per month. You're already giving the bank an extra $5,640 per year in just interest payments. But we can look at this graph and say 5.1% is kind of normal. We're right back to just above the 2018 mortgage rates, and we are still lower than the 2009 levels before the bubble popped, and it's been even higher than that before. Surely this is not the end of the world. If interest rates stopped right there, then I'd agree. We're probably going to be fine. But this parabola isn't done parabolaing yet. Analysts expect the Fed is going to push 11 more rate hikes through the end of 2023, and the Fed stated its target interest rate is 2.75%. Right now, the Fed rate is 0.5%. This doesn't mean we'll see 5x mortgage rates from here, since that would completely destroy the housing market, but we should absolutely anticipate this rate going higher through at least 2023. So let's approach our numbers again with a $600,000 house, the median price in my target market north of Charleston, South Carolina. December 2021, interest rates were 3.1%. You're paying $2,560 a month on your loan. 4 months later, in April 2022, same loan is costing you $3,250. That's about $700 more in monthly payments, just going to interest. Now let's conservatively estimate 7.1% interest rates by the time Jpow is done with his price hikes. Same house is over $4,000 a month. Anyone could buy a $600,000 house when your monthly payment is only $2,560, but a much smaller market is able and willing to buy that house at $4,000 a month. So what needs to happen? As these interest rates rise, there will be fewer buyers because fewer people will be able to afford these high monthly payments. So if interest rates stay elevated, and they probably will, the number that needs to change is this one, the loan amount. People would need to put up larger down payments to reduce the loan amount. And I don't see any reason to believe that in this bear market, people are going to be more likely to have cash lying around than they did a year ago. So even more likely than that, the asking price on houses is going to have to come down. $4,000 a month might be out of reach. There are fewer buyers. But what if these higher priced houses had a lower asking price? What if you're only asking $550,000? Maybe $3,700 a month is low enough for buyers to come back. $3,300 if you drop the price to $500,000? How low will the prices have to come down to satisfy the buyers? That is the question. But I do not see any way in which housing prices can continue to stay so high as rates rise. We're going from $2,500 a month to $4,000 a month. There just won't be the same quantity demanded at those prices. But Mikey, we've got people going in all cash to buy houses. They don't need to worry about interest rates. There's no loan. That's true. We've seen a lot of people selling their houses in high cost of living areas and making all cash offers elsewhere. But in order to have that cash, you have to sell your house to begin with. Today's buyers are yesterday's sellers. So if you can't sell your house for $600,000, then you won't have that money for a cash offer on a new home. And further, anyone who bought a house last year at 3% interest is awfully happy right now. I know BlackRock, Zillow, and other investment firms who bought up to a quarter of real estate sales in 2021 certainly are happy. With institutional investors likely getting a lot pickier in a non-zero interest rate environment, home sellers aren't going to see a swamp of all cash offers 25% above asking anymore. You know where the real BS is though? It's right here. The last time mortgage rates were sustained above 5% was 2005. At that time, the Fed rate was, you guessed it, about 2.75%. That's the Fed's current goal for about 16 months from now. Banks are currently borrowing from the Fed at 0.5% and lending it out at 5.1% in anticipation of eventually being able to justify that price as their rates rise in the future. Unless banks start competing to thin those margins, we're just throwing money into Bank of America's balance sheet. Talk about fair market competition and the invisible hand of the economy at work. I'll tell you what we're likely to see a lot less of is things like this. $225,000 for a 600 square foot house up in the Barren Mountains. We're looking at about 20 miles north of Phoenix. A house like this could sell at such an inflated price if an investor expects prices to rise further for later resale. And in fact, I think that's what happened. September 2nd, 2021, this house sells for $160,000. March 2nd, 2022, back on sale again for $225,000. That's a 40% increase in a matter of months. Maybe Opendoor has something to do with this? I wouldn't be surprised if they bought it for $160,000, fixed it up a little bit, and are trying to flip it now. Maybe the detached laundry shed adds value. I mean, that is about $500 worth of washing machine and dryer right there. But with a rising interest rate environment, that's an unlikely outcome. So the real estate speculator is probably not going to take this deal. That's $375 per square foot. That's double the country's median price per square foot, and this isn't exactly a luxury building that could justify that price. Besides, anyone who's seen Breaking Bad knows that a location like this carries risk of meth. We can't overdo those extrinsic risks. But even though there is definitely Fed-induced pressure on the housing market, this doesn't mean we are doing another 2008. Back in the early 2000s, a lot of people were taking out adjustable rate mortgages. This was the bank's answer to rising interest rates coming out of the dot-com bubble. Tell people they should take out an adjustable rate mortgage that can fall when the Fed lowers interest rates again. This would cause your monthly payment to drop. Of course, the other side of that is when interest rates rise 400% like they did between 2004 and 2008. Suddenly, your mortgage payment goes up. People thought they were getting a $2,000 a month mortgage, and then 3 years later, it's $3,200. And then they lose their job in the 2008 recession and they can't keep up. Only a victim of a deceptive lender would have taken out an adjustable rate mortgage in the past few years. I don't think we have nearly as many adjustable rate borrowers this time around. We also aren't going to face subprime mortgage defaults like we did in 2007 to 2008, since regulations no longer allow banks to make such loans to wildly underqualified borrowers. So are we going into a 2008 style crash? Probably not. We just don't have all the ingredients. But are we going to see a slowdown in home buying and reduction in prices? Probably. So what do we do as aspiring homeowners? On the bright side, home prices might start becoming more affordable. But on the negative side, we're still likely to pay more for them. I don't think we can say for sure whether we should buy now before rates rise or buy later after home prices fall. Unless we know how high interest rates will go and how low prices will get, we don't have the data to work out that math. If we do buy, we should pay attention to where mortgage rates go from here. If mortgage rates unexpectedly decline, it may be worth going to refinance to get the lower interest rate. If rates continue rising, then be pleased that you got in before it became more unaffordable to you. Personally, I don't know what the hell I'm going to do. I might have to sell some stocks so I can make a larger down payment, or I'll just have to get a worse house than I planned on. In any case, congratulations to the homeowners who got in sub 3% interest rates in 2020, and dishonor on those investment firms who bought large swaths of housing so as to rent them out to aspiring homeowners. I hope your children are disgusted with you, and they do not come to visit you when you're old and alone. Thanks for watching, and I'll see you next time.